Is it the buying opportunity of a lifetime for bonds? I cannot help but feel the bond market has so much upside. It's nuts to me. Um, it's tumbled like crazy. It's never tumbled this much. And I just look at this. Here's the Fed funds rate. Literally in March 17th. Today is the 27th of September. So we're 9/27, 3/17, 6 months ago. The Fed funds rate was at a quarter. At a quarter, amigos. Now it's at 3.25. It's crazy. If we take our trusted calculator, we go 3.25 divide by 0.25. That's I don't even know what that's 13 times what it was literally 6 months ago. This is insanity. I think it's like 1,300% or something like that. All right, so let's go back to the history here. I want to show the other times it raised. So we're going to go back to other raising right here. December went from 2015 went from 25 basis points to 2.5 over the course of 3 years. 3 years. We've dwarfed that in 6 months. It's insanity. We go back to 99. Right here, 2004 went from 1.25 to 5.25 in 2 years. 1.25 to 5.25. No, so we take 5.25 divide by 1.25. That's up 4.2. We're 13 times. That's 4.2 times, and that took 2 years. It's 6 months. It's insane. Then we go back to the 90s right here. 1999 went from 5 to 6.5, and that right there has smoked a lot of bonds. Actually, I remember that raising 19. We're going back to 94. Right here, 94 went from 3.25 to 6 in the course of a year. And 1999 was freaking in the course of 6 months. It went from 5 to 6.5. No, about a year. Yeah, about a year. This is crazy to me. How much is the Fed funds rate? So let me show you something else. So here we are in 1972. The Fed funds rate was at 3 something. 3, let's say 3.25 for simplicity. I can't quite get it right there. We're gonna say 3.25. I thought, yeah, right there. Okay, went from 3.13. That's weird. To 1972 to 12 point something in 1974. That's 400 increase, 400 times, or 400%, if you will. 1977, yeah, 1977 is down here about, was that 4.5 or so to 19. I mean, basically 20%. That's a 500%. We're above that, dudes. I mean, look at this. It's insane to me. That is the highest it's been since friggin' 2008. Crazy. That's. I mean, can I log this? Let me hold on a second. That looks bad, right? That looks real bad. Wait till we freaking. Hold on a second. Watch this. Look at that. When we actually log it, look at that, dude. That's insanity. This is as of August. It's not even as of September. If we go up to September, it's going to be. I mean, it's going to be up in here. By far and away, it's the biggest. I mean, it's the biggest. Look at that. So from here, what year is this? 2014, I guess. To friggin' 2018. So in 4 years, it went up close to what we're going through now in 6 months. That's crazy. So this from CNN, the Great Bond Market Massacre, the worst in history in 1994. Within 7 short months of the promising start, something fairly unusual happened. 1994 became the year of the worst bond market loss in history since the Fed began nudging short-term interest rates in early February. The bond market has inflicted heavy damage on financial companies, hedge funds, and bond mutual funds. Fortune magazine estimates the rise of the 30-year Treasury from 6.2 to 7.75 has knocked more than $600 billion of the value of bonds. And right here, this is from Forbes. Historically, fixed income have been a safe investment for investors looking to limit risk. That is until 2022 came around. This could be the worst year in history for bonds. And so far it is, man, without question. 2022 is shaping up to be the worst year by far for bonds. By far. I just want to go. So I want to go back. I want to show you something here. Here's Wellesley Fund, and this is basically 40, 60 stocks to bonds, but I just want to give you a gauge here. All right, so 1994, the worst year in bonds. The Wellesley Fund is down 4.44. 1995 is up 28.91. All right, not too shabby. Let's actually, I think I have it on a spreadsheet. And here's Wellington, which is the about the mirror opposite, about 65, 70 stocks to bonds. Is down 50 basis points, up 32.9% the next year. 1999, remember this is the first year in bonds. And we'll go into something else here in a second. 1999, 4.1 on the Wellesley, 16% the next year. 1999, Wellington was up both years, all right? Let's go to 2008. So that was a little bit of a unique. 2018, bad year for bonds because they're raising, as I showed you. 2.6 down for the Wellesley, up 16.4% the next year. Same thing with Wellington. All right, let me go to a bond fund. All right, we're going to go to Ginnie Mae. We'll look at one Ginnie Mae, and then we'll look at, I think it's the PIMCO fund, if memory, not PIMCO. That was the fund. So this is the longest known fund that I could get data for is the Putnam Income Fund. I'm not saying buy it. I'm just using this as a proxy for bonds. Then we got the Vanguard Ginnie Mae. All right, so let's take a look. Ginnie Mae's here, and this is Putnam right here. Let's go to 94. Look at all bond funds. 94 right there. Ginnie Mae was down 1% in 1994. The Putnam was down 3.3. Both came storming Norman back in 1995. 17 up for Ginnie Mae, 19.8 up for the Putnam. Yeah, Putnam. 99, Ginnie Mae was up 0.8%. Putnam was down 2. Both came storming back the following year. 2018, and then 2008, Ginnie Mae was actually up because it's government bonds. Putnam was down, then it came storming Norman back. And then 2018, Ginnie Mae was up. Actually, Putnam was up too. Interesting. All right, anyway, so that's interesting. So let's try something else here too. I just want to point out here real quick. This is the Putnam Fund. We're going to go to the 70s. Remember, we're talking about so here we go. This is the 70s right here. The Fed was raising all throughout the 70s. I already showed you. I don't have it up there anymore. But the Fed was raising. Look at that. From 1970 to 1981, the Putnam Fund had 4 down years, but one was -2, one was -7.5, one was -2, one was -2 basis points. Man. And finally, let's just go to, we're going to go to VBMFX. Yeah. And because what happens is that ultimately the Fed stops raising, and then you're getting those juicy yields once the Fed stops raising. Once the Fed inflicts damage, and it's so freaking evil, but it is, look, it is what it is, man. Once the Fed inflicts the damage, the bond market takes off like a freaking bat. And can I guarantee that? No. But look, we're already down 1.77 so far from last year. And that's on 2021. 2022 is the worst ever. 99 total bond market index was down 76 bips. Next year's up 11. 94 total bond market was down 2.66. Next year's up 18. Let me show you one other thing. This is the ETF version of the total bond index that I just shared with you. Year to date is down 14.8%, dudes. 14.8%. Isn't that crazy? In 1 year. This is after being down, what do we say, 1 point something last year. Man. Oops. Man. All right, so I'm only 52. I'm very comfortable in Wellington. I think about it all the time. I should load up on bonds more so, like just go straight Wellesley. But look, I'm 52. I like stocks. I like stocks with increasing dividends. I do. But man, I'm tempted to drop Wellington and go to Wellesley just to freaking load up because man, things are looking. At some point, the carnage that the Fed is inflicting on their insane raising to whip inflation when they can't whip inflation because inflation wasn't caused by the Fed to begin with. That's so doggone frustrating. All right, love your thoughts. Let me know. See ya.